Okay, peeps, welcome back. So today I'm going to be bringing to all of you 5 methods that can be used to protect your principal in TSLY. Let's get it. So the first method is to take profits on the way up on any positions that you own, and then move a piece or all of that capital into undervalued positions and then DCA on the way down. So I'm actually going to give you guys a live example of a position I'm in right now where I did this. All right, so as you guys can see on my dividend portfolio here, I am on TSLY. The current amount that I have in here, you guys can see that. You can also see my return is actually negative 13.5%. So for those of you that are in a drawdown currently on TSLY, just understand I'm with you on this. I'm experiencing this too. One thing I've learned over the years as an investor slash trader is to always try to keep a level head about things and understand that markets never go up forever, but they never go down forever. They move in cycles, they move in waves. Okay. So what goes up will come down, and what goes down will eventually go up. So why do I bring this up? Well, TSLY, when it was going up, as you guys can see on the charts here, when it was going up back in this area, I was loading the boat on my TSLY position and taking profits while it was moving up. And then I started buying more as it was moving down. I'll be honest, I didn't think it was going to go down this much, but when I got my dividends paid out to me, I reinvested it back into TSLY, which reduced my cost basis. So the dividends, as you guys can see, does actually offer some downside protection. If the dividends were not there, I would be down about 1,600 compared to 1,100. But that's actually not even the full picture. So I did actually take roughly about $200 to $300 in profit on the way up, and then I started scaling back into the position on the way down. And what I personally do is I take all of the profit and a piece of the initial principal, and I move it to another position that's undervalued. Typically, I don't move the entire amount. I just slowly start scaling out of that position as it continues to move up and put the money that I would take out into another position that's moving down. So you guys can see my current share price, $16.97. Current price is $14.55. However, I'm still pretty bullish on TSLY. You guys can see the MACD cross to the upside. The RSI was oversold, and it also had a golden cross to the upside. This is on the 4-hourly chart. And we're about to get a golden cross on the EMAs, and price has bounced off of this range low. So what would be a good example of taking profits on the way up and then moving money into undervalued positions as that all-time high on the first position keeps moving up? So I'll use NVIDIA here as an example. NVIDIA's at all-time highs. I recently did take profit on this position, so I'm currently out of it, but I'll be back in before the X date. And I'll be taking a piece of that profit and I'll be moving it into either Aptly or OARC, one of the two. I'm not really sure which yet, and then I'll put the remainder of it back into NVIDIA. Now, the reason I do this is because it could always go higher, so it's kind of like a hedge against the upside and the downside. I don't want to draw it out too long because then this video will really drag on. I'll save my methods on that for a separate video. But this would be your first method, okay? The second method would be high yield savings accounts. As you guys know, recently the Fed's been raising rates like crazy since March of last year. The Fed funds rate, we can actually look at it right here, is 5.12%. They're still trying to make sure inflation stays down. So the mortgage rates, the savings account interest rates, and the auto loan rates are all tied to whatever the Fed funds rate is. So if the Fed funds rate goes up, all of those interest rates go up. If it goes down, they all go down. So this is good for high yield savers. I have a link here to bankrate.com with all these different high yield savings accounts that you can use. These are like traditional banks that have online platforms, I guess. So SoFi is 4.5%. You got some others here. Just keep scrolling down. US Bank, Barclays. Well, I wouldn't really go, if you're looking for high yield savings, I wouldn't really go with Wells Fargo, Chase, or B of A. That's more of the big banks, they don't typically offer a great amount of interest, but it's more for like fraud protection and stuff like that. And, in case of the banking crises, like with Credit Suisse and a couple others, I forget which one they are. It's like some Silicon Valley bank or something like that had to get bailed out by the Fed recently because of the rate hikes. So it offers some protection in the event of a bank crisis going with the big banks, but you're not going to get a high yield with those guys typically. So you got some others here. Just keep scrolling down. I'll leave this link in the description for you guys to check out for yourself. Throw a couple extras on top of here. Ally Bank, they're really good. They're actually they've been around for a long time. How long exactly, I don't know, but they offer 4.25% on savings. Robinhood, which I use, offers 4.9% on savings. Um, so this would be number two. So basically, the idea would be if you don't want to be fully invested in the market, you want to be like 50% in the market in case it goes up, but also 50% in cash or cash equivalents in case it goes down. Um, if the market's going down and you don't feel comfortable investing while it's being drawn down, you can take some of the cash that you have on the side and invest it into these, which would give you a nice return on your money. Now, understand when the Fed starts cutting rates, these interest rates will go down. Me personally, I am actually not putting any money, and I do not have any money in the high yield savings rates or the next method that I'm going to talk to you guys about. And the reason being is because from somebody who understands and studies macroeconomics, the best time for me personally to get into a high yield savings account would have been back in March of 2022 when the Fed began raising rates, not at this current point when it looks like they're almost at the end of their hiking cycle. But if you guys want some money in the immediate short term and you want to make money on a risk, potentially as high of a risk free investment as possible, while you're waiting for the Fed to cut rates and protect against downside in your dividend stocks, this is a good way to go about it. The third method would be treasury bonds and or this is a treasury bond of some kind. Not exactly sure 100% what this is, but it's a Series I savings bond, which is more or less designed to kind of match inflation. So it says here, a Series I savings bonds protects you from inflation. With an I bond, you earn both a fixed rate of interest and a rate that changes with inflation. Twice a year, we set the inflation rate for the next 6 months. So if you bought in at the beginning of that 6 month cycle, you would get that rate for the following 6 months. Let's say the Fed decides to cut rates down to zero over the next 6 months, and the cycle just started now, and you got in at the beginning of the 6 month cycle. If the Fed funds rate is still if the Fed funds rate is down to, let's say, 1 or 2%, you would still be at 4.3% on this thing for the following 5 months. Okay. That's one good thing about treasury bonds. When you buy them, you're usually locked in at a certain rate for a period of time. So even if the Fed cuts rates, you still get that higher rate for longer. Another good one would be treasury inflation protected securities or TIPS. It says they sell them for a 5, 10, or a 30-year term, I guess. I'm pretty sure inflation's not going to be at 5% in 5 years. Don't quote me on that. But if the Fed keeps on with what they're doing currently, then inflation will be back down to 2%. And you could potentially have this as a hedge in the meantime, although your money would be locked in for a long time. And most likely, if you withdraw prematurely, you're going to end up having to pay some kind of penalty. It works the same way with certificates of deposits. So they kind of show you all the details here. I can leave this in the description for you guys if you want to check it out. They have like a bunch of different stuff here under the treasury marketable securities and savings bonds. I personally don't know what the difference of all these are because I don't own any, but this is a third option to basically hedge your portfolio to where you're not feeling the pain of the drawdown as much. The fourth option would be swing trading. So I'm going to go ahead and pop my account up here in Webull. As you guys can see, my current account value currently got some dividends in there, which you guys know I have clip and other things in this portfolio. But what I want to show you guys is all the different profitable trades that I've had over the last, I'd say it's about 4 months because I opened this account right around April timeframe, April, May. So I've made some profits here on some of these swing trades. You can see got 39.45, 72. I'm actually currently still in clip. This is when I took profit before in between the ex dividend dates. Snap $130, NVTA 150, Twist 151. Then you got 154, 155, 162, 166, 170, 196, 259, 310. As I told you guys before, I recently took profits on NVIDIA. This is the profit combined with the dividend. Open door 318. That's actually not accurate because I'm currently an unrealized profit. But if I wasn't in that trade, it would still be like around $200. EVgo 350. So what is the overall idea here with swing trading? So I have a portion of my money in dividend paying stocks and a portion of my money in small cap, potentially highly explosive to the upside, big gainer tech stocks, right? Very high growth, small cap tech stocks. So the tech stocks themselves do not pay a dividend, but the amount of gains that I can make on some of these trades is absolutely insane. I'm actually going to show you guys a potential setup here real quick. So we'll use the current setup that I'm actually in right now as soon as I find it. So I made a video previously that you guys can check on my channel about Open Door. Basically, I got in right around here. What I'm looking for is for it to move up roughly about 20%, and I'd be taking profit here, which would yield me about $250. It's not considered dividends, but it does add to the monthly income. But this thing could go way higher. When I initially got into this trade a long time before, I got in like right around here when we had this bounce off the EMAs on the 4-hourly. And I got out for about I think it was like roughly about a 16% profit. But as you guys can see, this thing just went ballistic. It went up 180%. So basically, what I would do is I'd take profit on these positions and move some of that money into my dividend portfolio to increase my dividend income, but also at the same time use these high growth small caps tech stocks by taking profit on those positions. I'm realizing gains that are offsetting some of my unrealized drawdown / losses on my dividend portfolios. So that's method number 4. Method number 5 would be to diversify. So what do I mean by this? Well, basically, pretty much what it means is you have more than one or two or even a handful of positions in your overall dividend portfolio. As you guys can see on this account here, I have 1, 2, 3, 4, 5, 6, 7, 8. Keep going down. 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. I got to rebuild these back up. 20 positions here on my monthly dividend paying stocks. And then if I go to the other side of my portfolio, I have 1, 2, 3, 4, 5, 6 dividend growth stocks. So 26 in this particular account right here. And then I also have 1, 2, 3 dividend paying stocks. I'll be adding NVIDIA back to this once the settlement date is passed. So it would be 4. So that's a total of 30 different positions across just these 2 platforms. And I also have 3 positions on Robinhood. So that's a total of 33. You're a lot more diversified and a lot less exposed to downside risk if you own several dozen stocks versus if you own 1 or 2 or 5. Some of those positions could go up while other positions are going down, and you'd be less likely to feel the pain of the entire drawdown. So basically what I'm saying here is I'm not going to put all of my money into the yieldmax funds. It's a great boost for income, but I like to stay diversified. So anyways, I hope this helps you guys, potentially deal with some of the emotional stress of the drawdowns. As you guys can see from my accounts, I'm going through the same thing. I'm pretty much right there with you guys. So these are my methods. Hope it helps. Please like, comment, and subscribe, and I'll see y'all later. Peace.